case of fixed exchange rates and show that monetary policy is not independent anymore in such a situation. To do this, recall first the interest rate parity. With the interest rate parity, we had that 1 plus the interest rate at home must be equal to 1 plus the interest rate abroad, multiplied by the exchange rate at time t divided by the exchange rate at time t plus 1 that is expected at time t. So we have here the expected appreciation or depreciation of the currency. Now, if we have a fixed exchange rate, of course, then there is no expected appreciation or depreciation. This term here is just equal to 1, and from this it follows that the interest rate at home has to be equal to the interest rate abroad. So the interest rate of the home country, if it backs the currency to another country, will be equal to the interest rate of this other country. So the central bank of the currency that backs to the other currency cannot perform independent monetary policy anymore. It's tied to the interest rate settings in the other country. As an example for this, consider the European monetary system, which was in place before the introduction of the euro as a common currency. So in this system, the currencies of European countries were tied together by a quite fixed peg. And then the German reunification happened. And during the German reunification, which was very generous in exchanging the mark of the Eastern German countries to the Western German mark, that therefore led to an increase in demand, because then many of inhabitants of what was previously Eastern Germany could afford much more consumption. So there was the danger that the economy overheats, and therefore the German central bank, the Bundesbank, had to raise the interest rate to cool down the economy, basically. However, other countries in the European monetary system did not have such a demand shock. So their interest rate policies would have had to be different. And since Germany increased the interest rate, these countries then had to stem against capital outflows in order to defend the peg to the German mark. And now, of course, this led to reductions in demand in these countries and to recessionary pressures, and also to pressures on their currencies to devalue. So there were then speculative attacks. Now, these countries did several things to try to defend the peg. So they used the reserves of their central banks to buy the home currencies to prop up their value. Then later on, they had at some point to increase their interest rates, despite the fact that they would actually have had to decrease their interest rates from a business cycle perspective, but they had to increase the interest rate in order to stem capital outflows. And then at some point, pressure was just too large, so they had then to devalue and give up the peg in the end. And this was in 1992. So we have seen that in the short run, the fixed exchange rate deprives an economy of one adjustment mechanism to shocks. So usually with a flexible exchange rate, if one country is hit by a demand shock, by a positive demand shock, and then increases the interest rate, that just leads to a rise in its currency's value, so to an appreciation of the currency, which in turn would make exports more expensive and imports cheaper, so that there is an adjustment mechanism then via the net exports to the other countries, so that the shock is absorbed partly through exchange rate movements. So in the short run, this mechanism is not available anymore for a country that backs its currency to another country, or for a country that joins a monetary union. What is possible, however, is that the real exchange rate could still change in the medium run. Why is this the case? Well, recall for this the real exchange rate, which is the nominal exchange rate multiplied by the price difference between the home country and the foreign country. So it adjusts the nominal exchange rate for price differences. And now we see that the real exchange rate can change over time, even if the nominal exchange rate is fixed, because there may be different price movements in the two countries. For example, if the foreign country enjoys a boom and inflation rates are high, the price level would increase faster than in the home country, which would lead to a depreciation of the home currency. Now let's consider this argument in more detail. We write down the Phillips curve with anchored inflation expectations, which means that the expected inflation rate is equal to the inflation rate by bar, which is the anchor. Then we have the Phillips curve that the difference of the actual inflation rate minus the anchored inflation rate would be equal to the difference between actual output and potential output multiplied by the parameters that determine the sensitivity of the inflation rate to departures from potential output. Now assume, for the sake of the argument, that the foreign economy runs at its potential capacity, which would mean that its actual output level is equal to its potential output level, which would imply that the actual inflation rate is equal to the anchored inflation rate. That would imply that the inflation rate at home would need to be equal to the foreign inflation rate, because otherwise there would be continuous real appreciation or real depreciation, and therefore continuous deviation from the potential output level at home. So in the long run, the target inflation rate at home must equal to the anchor that is used abroad. So the target inflation rate at home and the anchor abroad must be equal in the long run. However, in the medium run, there could be some adjustments, as we will see in a moment. So we plug in the target inflation rate abroad here as the anchored inflation rate at home and get the modified Phillips curve then here. And now consider that there is a recession at home. In this case, we would have that the home inflation rate, denoted by pi, is smaller than the foreign inflation rate and also the foreign anchored inflation rate by bar star. Now this in turn would lead to a real depreciation because the home price level increases more slowly than the foreign price level. So the home currency would depreciate in real terms. Now, a real depreciation, as we know, would induce the following effects, assuming that the Marshall-Lerner condition is fulfilled. The real exchange rate decreases, then this would make exports of the country cheaper and imports more expensive. So net exports would increase in the medium run, according to the J curve, basically. This would increase economic activity at home, and therefore it would increase actual output. And the process lasts until actual output at home is again equal to potential output, such that also the inflation rate would then again be equal to the foreign anchor of the inflation rate. And this would then be restored. So to summarize, even if a peg of the home currency eliminates one adjustment mechanism in the short run, so the nominal exchange rate cannot be changed anymore, there would still be the ability to absorb shocks through the real exchange rate, because the price levels may increase at different rates in the different countries. Thank you very much for watching the video, and I hope you found it interesting and useful. For more videos on economic content, please visit my channel that you find here to the left. And to the right, you see the next video in the series at the top, and at the bottom, you see the whole lecture in the form of a playlist.